Bhaskar Panda is joining us now, Senior Regional Head, Treasury Advisory, HDFC Bank. Lots to talk about with the yield now over 1%. What are the factors that have driven the curve upwards, especially when, with the recent meeting suggested no plans to taper stimulus? Let's get into that. Bhaskar, good morning. How would you define this move? What do you feel has really been, the driving force behind it?
Good morning. I think let's start with the US yield curve, which had moved quite a bit in the last few trading sessions, and the drivers behind that. So obviously, one of the drivers was the political drama that happened in DC. Apart from that, the most important driver that has been, trending is the fact that some of the governors, Fed members are talking about taper already, and they have been, little more vocal than they were earlier. So that is one of the very important reasons why the US yields had actually moved up. And if you see, but it had gone to a high yesterday, but it is now, come back a little bit down today. And looks like today's, I think there is a 10-year bond result will come today. Tomorrow is 30-year. So this all will indicate, and this all will give us the indication as to where the yields is moving forward. So my view is that US yields could remain a little elevated, not too much, but a little elevated on the base of these, taper talks that is happening in the Fed corridors. Now coming back to India, India is a little different than US. We just don't follow blindly what US is doing or what US yields are doing in the market. What we follow is both global as well as local cues. So local cues, if you see, our inflation has actually, yesterday the numbers were a little lower than forecasted. So the CPI inflation is coming down a bit. The IIP figure was bad, but let's forget about that right now because we're talking about only bonds. So given that scenario, the 10-year yield is, going to remain, in my sense, between, say, maybe 585 to 595 kind of range for the time being. And given that the liquidity also is being sucked out by, central bank, so we need to be a little careful there how we position ourselves. But for the time being, I think this range is good enough to play out in the market.
Do you see this as a challenge for equity flows as well? Does it suggest perhaps that the best of the low rates that we've seen in the US are behind us?
I think the best of, low rates is behind us. That is something which is getting indicated by powers that be in US, and I believe in that. So I don't think you will get much lower than this. Second thing is that the second direction that one should think about is that the liquidity scenario. So liquidity scenario is going to remain as it is, or is going to remain actually pretty good. So in that sense, the flows that were coming into higher yield markets should continue. I don't see a complete stop there or withdrawal from India as of now. But yes, depending on the returns that markets give, including India, so flows will definitely come in. As of now, I don't see there's any dearth of liquidity, though a little bit of yield enhancement has happened in last 2-3 days. But I don't see any reason that India shouldn't get any flows, at least in the first half of this calendar year.
All right. Thank you so much, Mr. Panda, for joining in and sharing with us the outlook on the US yields as well as the overall macros.